Imagine a world where the prices of everything from milkshakes to mustache wax are constantly on the move. One day, you're sipping a milkshake for $1, and the next day, it's like the milkshake has taken a class in fancy footwork and raised its price to $3. That's right, folks, we're talking about inflation. So buckle up because we will talk about it in this video together with this prominent economist and professor, Nouriel Roubini.
The existence of geopolitical stuff, deglobalization, other factors imply that inflation is going to be more persistent. It's falling, but not fast enough.
In the video I showed you, Roubini, an economist and professor known for his expertise in macroeconomics, is suggesting that various factors indicate that inflation is expected to continue and remain at elevated levels throughout the current year. There is a likelihood of an upward trend in general price levels that is expected to continue for an extended period rather than being a temporary phenomenon. Now, the factors that Nouriel Roubini is talking about as to why inflation is continuously persistent are labor markets being very tight, unemployment rate at historical lows, excessive wage growth, geopolitical tension in the world, among others. So, what will happen now if inflation persists? According to Roubini,
and therefore central banks are going to face a dilemma, or better, a trilemma.
Central banks play a crucial role in managing the economy and maintaining stability. One of their primary objectives is to achieve price stability, which means keeping inflation at a moderate and predictable level. However, achieving this goal can be a delicate balancing act, especially when other factors like economic growth and financial stability come into play. When inflation starts to rise above the desired level, central banks face a difficult decision. On one hand, they want to address inflationary pressures and prevent a sustained increase in prices, which could erode the purchasing power of money and disrupt economic stability. On the other hand, they need to consider the potential impact of their actions on economic growth and financial stability. Raising interest rates is one of the tools that central banks can use to combat inflation. By increasing borrowing costs, central banks aim to reduce spending and borrowing in the economy, which can help cool down demand and alleviate inflationary pressures. However, raising interest rates can have consequences for economic growth and financial stability. If central banks decide to raise interest rates more aggressively to tackle inflation, it could potentially slow down economic growth. Higher borrowing costs make it more expensive for businesses and consumers to borrow and invest, which can lead to reduced spending and investment. This, in turn, may have a negative impact on overall economic activity and job creation. Moreover, raising interest rates too quickly or by a large magnitude can risk triggering a hard landing scenario. A hard landing refers to a rapid and abrupt economic downturn that could result from overly restrictive monetary policies. Such a scenario can be detrimental to businesses, employment levels, and consumer confidence, and could lead to a deep and prolonged recession. On the other hand, if central banks prioritize growth and financial stability by keeping interest rates relatively low, they may face the risk of a de-anchoring of inflation expectations. Inflation expectations play a crucial role in shaping actual inflation outcomes. If individuals and businesses expect inflation to remain low and stable, they are more likely to make decisions that align with this expectation. However, if inflation expectations become unanchored and start to rise, it can fuel a self-reinforcing cycle of higher inflation. In a scenario of de-anchored inflation expectations, businesses may adjust their pricing strategies and workers may demand higher wages to protect themselves against expected price increases. This can lead to a spiral of rising prices, eroding the effectiveness of monetary policy and making it more challenging for central banks to regain control over inflation. Central banks must carefully navigate these conflicting objectives and potential risks. They need to strike a balance between addressing inflation concerns and supporting sustainable economic growth and financial stability. This often involves assessing a wide range of economic indicators, data, and market conditions to make informed decisions. In practice, central banks adopt a gradual and data-dependent approach to monetary policy adjustments. They monitor various economic factors, such as GDP growth, employment levels, wage growth, productivity, and inflation trends. By carefully assessing these indicators, central banks can determine the appropriate timing and magnitude of interest rate adjustments. Additionally, central banks often communicate their policy decisions and intentions transparently to help manage inflation expectations. Clear and effective communication can provide guidance to businesses, consumers, and financial markets, influencing their behavior and reducing uncertainty. This, in turn, can contribute to anchoring inflation expectations and enhancing the effectiveness of monetary policy. It's important to note that the specific strategies and actions taken by central banks can vary depending on the economic circumstances and institutional frameworks of each country. Central banks often work within a broader policy framework that includes fiscal policies, regulatory measures, and coordination with other authorities to address broader economic and financial stability objectives. Aside from the central bank, we should also look into the future of the US dollar when inflation comes, which actually is not far from happening.
There's a risk of rising inflation and debasement of fiat currency.
When inflation starts to rise, it's like the US dollar superhero getting a bit weaker. Its superpowers of maintaining value and stability aren't as strong as before. People might start doubting the US dollar's strength and reliability. They might wonder, is our superhero losing its touch? Can we still trust the US dollar to hold its value? The uncertainty surrounding inflation creates doubts about the future of the US dollar. Will it be able to maintain its status as a trustworthy currency, or will it face challenges? It's like a cliffhanger in a superhero movie, where we eagerly wait to see if our hero will come out on top. There had been multiple perspectives that arose about this topic on inflation. A budget-conscious shopper had said, and I quote, "Rising inflation is a cause for concern. It means that the prices of everyday goods and services are increasing, making it harder for me to manage my expenses." On the other hand, economists and experts alike have said that moderate levels of inflation can be beneficial for the economy. It encourages spending and investment as people try to avoid the erosion of their purchasing power. The conversations surrounding inflation, central banks, and the US dollar highlight the complexity and interplay of these factors in shaping the economic landscape. Finding the right balance between price stability, economic growth, and financial stability is a delicate task for policymakers. It requires a nuanced understanding of the dynamics at play and the implementation of appropriate measures. As we conclude, it becomes evident that staying informed, fostering open dialogue, and engaging in proactive policymaking are crucial in effectively managing inflation. By continuously monitoring inflationary pressures, maintaining a stable currency, and considering the diverse needs of individuals and businesses, we can strive to create an environment that promotes sustainable economic growth and prosperity. What do you think about this topic? Let me know in the comments section below. Don't forget to like, share, and subscribe to Finance Zoom channel. I'll see you in the next video.